of a DTI ratio to qualify. Also, too, you can qualify for an FHA loan often with a slightly lower credit score. Again, the Federal Housing Administration is insuring this loan, so they're alleviating the risk from the lender. So they're encouraged to loan you the money, and that's why they're willing to do it on slightly, and I say slightly because this isn't a cowboy loan, slightly looser guidelines than a conventional loan. And one really cool part about the FHA loan is it typically carries a slightly lower interest rate. And for all the reasons that we just mentioned, the risk is greatly reduced to the lender when they fund an FHA loan. There's one downside to an FHA loan, and it's really the only downside, is the mortgage insurance. Now, we talked in length last week about mortgage insurance, and you may recall that mortgage insurance is that piece of your monthly payment that pays for the insurance policy that insures the risk to the lender. So you're paying the PMI or MIP or MI, remember we broke it all down last week, with an FHA loan indefinitely, right? So as long as you have that loan, you're paying that monthly mortgage insurance as part of your payment. The only way to get rid of that is to refinance at a later date into a conventional loan. So if you buy a property today and you've got a historically low interest rate, you're going to have to refinance that down the road to drop the mortgage insurance. And sometimes it's a significant part of your payment. You know, depending on the loan amount, it could save a couple $100 a month to drop that MI. So with a conventional loan product, once your loan balance reaches 78% or less, and that can be accomplished one of two ways, and we talked about this too, appreciation or principal reduction. Just by you making your payments each month, your principal balance goes down. Once that number hits 78%, and the lender requires it to be at least 12 months in some instances. It used to be 5 years, but check with your lender. You can petition to, and by petition, it's a phone call, right? So you call and request that the mortgage insurance be dropped. They may require an appraisal, but if there's enough appreciation that they can use what's called a desktop appraisal to get a firm value and determine that you are indeed less than 78%, they'll drop the mortgage insurance automatically. So that's the only downside to an FHA loan, is that mortgage insurance lives with the loan indefinitely. But it's a great, great loan product for a first-time home buyer who needs to stretch that MI a little bit or has a slightly lower credit score. Great loan product, and I certainly encourage you to use it if you can. We have a standard practice at the Mr. Mortgage team where we'll try to start with the best program first. So we're going to try to get someone approved with a conventional loan. And one last thing, I guess, about FHA is it's a 3.5% down payment, and you can use gift funds. So your parents, grandparents, a close family member can assist with gift funds for the down payment. And conventional has a program too, very similar. But the benefit, as I mentioned, of the conventional is you can drop that mortgage insurance. So great question, great loan product for the first-time home buyer because of that additional flexibility. So, and I'm super excited for you as you start this journey towards home ownership, because as we mentioned, it makes a lot of sense. And I wanted to share a story, and I'm going to try to make it short because, my stories go long. I was in the lobby of my building yesterday, just leaving for the day, and there's a law firm on the second floor, and out of the elevator came three of the ladies that I meet them in the lobby regularly, so I know they're all paralegals upstairs. And based on their appearances, I'm guessing, mid-20s, maybe 40, and then there was an older of the three was probably in her mid-60s. And the younger girl was super excited that she had just signed a lease with her two roommates, and they're each paying $800 a month. So I did some quick math in my head and figured, you know what, she's paying $2,400 a month for rent. The lady that I'm guessing was about 40 said, my first apartment was $800 a month, and it was just me. And the woman that I'm guessing to be in her mid-60s kind of chuckled and said, my first mortgage payment was $800 a month, including everything. And that's where the conversation ended, or at least for me as I walked to the car. But it got me thinking that somewhere in the future, and maybe not the distant future, that 20-year-old girl is going to be chuckling that her rent was only $2,400 a month, or that her mortgage payment was only $2,400 a month. And that got me to do a little Google research, and I double checked a couple things. So there's a website called Zumper, and it's a rental reporting site. And they reported that the average rent in West Palm Beach was $2,855 a month for a 3-bedroom apartment. And 61% of the landlords surveyed in West Palm said that they plan on increasing the rent this year. So really quickly banged out some math, and I found a $350,000 house. And granted, it was in Port St. Lucie, not West Palm. But with a 3% down payment and $200 a month going towards a homeowners association, you could buy that $350,000 house for just $28.41. So less than rent. $28.55 was rent, $28.41 was the mortgage payment, using an FHA loan as a first-time home buyer with just 3% down on a $350,000 house. And just to stretch that out, appreciation at 8% over 5 years would net you $164,000 in equity if you were to buy that house instead of rent. So we're going to be on the other side of this break. I hear the music rolling in, so that means I need to get moving. Continue to send us your questions. Call or text 561-291-8569, or visit the website www.mr.mortgage. That's mr.mortgage with no .com. It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at soflappraisal.com. That's soflappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. soflappraisal.com. And tell them you heard this on the Mr. Mortgage Show.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, so we are back. That's 561-291-8569. 291-8569 is the Anytime hotline. And anytime that you want to jump on the internet and find us, it's www.mr.mortgage. That's mr.mortgage with no .com. So just to kind of finish the thought up on that appreciation, I know I kind of snuck that in at the end there with, 8% appreciation would net a significant return after just 5 years. And a lot of people are waiting for appreciation to slow. But I read an interesting article this week and I'm not going to go into length on it, but so why is appreciation still at why is there so much demand pushing pricing up? And I think there's two different things happening, right? One is, there's demand, as we talked about, that there's just not enough inventory. But there was an interesting article that Redfin did a study, and it was the mortgage broker or I don't remember who it was. I printed it out here, but the National Mortgage Press, I think it was, ran the report. And out-of-town buyers are paying on average 30% more for properties than locals, if you will. And what's happening is, and this isn't rocket science. We're seeing it in the news. People are moving from more expensive regions, cashing out a big piece of equity, and its perceived value. They come down to, Florida, and the properties in their mind are half price. Everything's on sale. And the local people are like, wait a minute, this is all-time appreciation. We're getting priced out. So, you've heard it said that perception is reality. And I think that's what's happening. I think the perceived value of, to use Brianna in Loxahatchee, I'm close with my sister out there, and there's a spec home going up by her on an acre and a half for $1.1 million. And if you're moving from the city of New York, that probably feels like a bargain. I've got this big piece of property. I've got a canal, which, is a glorified drainage ditch, but nonetheless, a canal in my backyard, and this big, beautiful 5-bedroom home. Yeah, 1.1 million's a steal. So perception is reality. We know that. And these prices, as you cash out of those northern markets, are still a perceived value. So I think that has a lot to do with our local market anyway. And the article covered many, many metros, but one in particular was Nashville. And I guess a lot of people from Los Angeles are moving to Nashville or that county. I'm not that familiar with California, but nonetheless, the average sales price from that location was $950,000. Yet the average purchase price, in Nashville was only $411,000. So you can see how that perceived value exists for that out-of-town buyer. So let's jump into some more questions. I saw some pop in. I think Dom has one queued up for us. What do you got, Dom?
Yes, we have Michael from Pompano. Michael said, so last week you said I could borrow 90% without having to pay mortgage insurance. But I asked my mortgage guy, and he said, that's wrong. What's up with that?
Hey, Michael, I love the swagger in that question. So your guy's wrong. That's just the reality. And in his defense, not a lot of lenders have the program. It's a fairly new program. But I assure you that a 90% loan with no mortgage insurance does exist. And it's a powerful tool in this market that we're in. Just from the very basic stance that you can put less money down on a property and not to have to pay that pesky mortgage insurance, which, we've beaten mortgage insurance over the head the last couple of shows, but that doesn't benefit you. It only benefits the lender. That's insurance against risk. So yes, your guy is wrong. There is a 90% loan with no mortgage insurance. And as I mentioned, it's, for a lot of reasons, a powerful tool, but I want to share a real world story with you. And this is a property that is a borrower that we're currently working with, and they're buying a property down in Weston. And it's a townhouse. And I want to use this example as it is current and real. So we've all heard about appraisals not hitting the purchase price, and then that causes a whole domino effect on the buyer needing to bring more money to the table, or in this case, borrowing a bigger percentage and having to pay that pesky mortgage insurance. So we're using the 90% loan with no mortgage insurance in this exact example. So it's a $370,000 purchase price, and this borrower is intending to put 20% down. So her intent was to put $74,000 down and take a $296,000 loan. Now she has the money to do it. So there's a lot of, ability to work within these programs here. But her whole reason for dropping 20% on this property was to avoid mortgage insurance. She's, very fiscally responsible. She's conservative. Her mindset is a bigger down payment avoids that mortgage insurance. Brilliant, brilliant strategy. Here's the problem. The property only appraised for $330,000. So as we talked about in an earlier show, the lender is going to use the sales price or the appraised value, whichever's less, to determine how much they'll loan. So now she's going to borrow 80% of $330,000. Now, in order to do that, there's a big piece of the puzzle missing. She's going to have to tap her 401k, which she doesn't want to do, to put more money down. So dun, 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 the superhero loan, if you will, comes flying in to save the day. We use the 90% no MI loan. Her objective is met. She's not paying mortgage insurance. And so here's the math. This is really cool. Follow me here for 1 second. On a $370,000 purchase. Now, these are round numbers. No closing costs, no, title